Howdy, and welcome back to Miller Momentum. Today, I'm finally going to do it. I'm going to talk about AI. I know, but before you boo me like some B-list boomer commencement speaker, hear me out. I've got a more nuanced and contrarian view than the usual offerings on YouTube. But first, the usual disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. The Magnificent Seven now make up roughly 35% of the S&P 500, the same concentration we saw at the peak of the dot-com bubble. And when it comes to index funds, that's just a fact, neither necessarily good or bad. It's simply where the market is at. Anthropic just closed at around $965 billion in valuation. OpenAI, last time I checked, is somewhere between 750 and 850 billion, and depending on the week. And the hyperscalers are projected to spend $725 billion on AI infrastructure this year, with Moody's putting that closer to $785 billion. All big money amounts in a big pot of big money soup. Anyway, I'm not all in on this trade. What I've got in AVGV and GDE is good enough for me. I think the S&P 500 and the global stock market index funds cover it. Of course, I'm not a bear on AI. I think it's an important and somewhat useful technology, but I have three reasons I'm holding back on any direct individual stock purchases in this area, and on at least one of them, I think the market has it absolutely backwards. For each reason, I'll give you the strongest case against me too, because if a thesis can't survive the best version of the counterargument, it's useless. So, let's get into it. First, I don't think the pure plays, Anthropic and OpenAI, justify their valuations. The bull case rests on the assumption that what they've built is defensible as a moat, and I don't think it is. Here's why. So, distribution. Google has Gemini in front of over a billion monthly search users. Microsoft has Copilot wired into every Office, Windows, and Azure account on the planet. And you know what? I'm one of the customers that has both Gemini and Copilot. And despite their drawbacks, if you play around with them enough, you can get just as much use out of them as you could with, say, Claude or GPT. The pure plays, on the other hand, have to acquire users from scratch. The hyperscalers already have them. So, also, compute. The hyperscalers are spending $750 billion a year on AI infrastructure. They're the only entities that can fund data centers, energy contracts, and chip supply at frontier scale. Anthropic and OpenAI rent that compute, they don't own it. And this brings me to cash. If a pure play invents something genuinely novel, the incumbents either replicate it or buy it. Amazon has already put $8 billion into Anthropic, and Google's in for over a billion. Microsoft has committed tens of billions to OpenAI. These aren't really independent companies anymore. They're research and development arms of big tech with some extra paperwork. So buying the pure play story isn't betting on an underdog. It's betting that a research division of the cloud incumbents escapes gravity and becomes a new incumbent itself. And historically, that just doesn't happen all that often. The best pushback against me here that I can think of is talent. Anthropic and OpenAI attract the best researchers in the world precisely because they're not Google. And the brain drain from the hyperscalers to the labs over the last 5 years has been real. The revenue is real too. Anthropic went from $10 billion a year in annual revenue to $47 billion in a single year, mostly on Claude Code. That's the fastest enterprise revenue ramp up in software history. but talent is mobile and compute is concentrated. And they're all still really, when you get right down to it, being paid by the hyperscalers. We heard the same internet native company argument during the .com era, and Microsoft survived the internet. Pets.com didn't. A 5 times year over year revenue ramp up doesn't justify a 78 times sales multiple unless growth never decelerates and margins never compress. Both of those assumptions break eventually in reality. The question is just when. And this brings me to my second reason for not being all in. And this is the one I think the market has backwards. If AI actually delivers on its promises, the tech sector might be the worst possible place to be invested with intentional overconcentration. So, Goldman Sachs just launched what they're calling the most important trade of 2026, a basket of non-tech S&P 500 companies that includes banks, retailers, logistics, healthcare, restaurants, all of these that are using AI to cut costs and expand margins. Their logic is this: AI is a productivity technology, and productivity technologies overwhelmingly benefit the user, not the seller. Electricity didn't make the utilities rich. It made every factory that could run at night rich. The internet didn't make the ISPs rich. It made Walmart and Amazon rich. If AI works, the biggest winners might be JP Morgan and Caterpillar, not Salesforce. There's already a name for what's happening to software: the SaaS-pocalypse, where SaaS stands for software as a service. In the first week of February 2026, over $1 trillion came off software stocks. In one 48-hour window, $285 billion vanished. Thomson Reuters had its worst single day drop on record, down almost 16%. LegalZoom fell nearly 20%. Software ETFs are down about 20% year to date, and Atlassian reported its first ever decline in enterprise seat counts. Workday, a company that sells workforce management software, cut its own workforce by 8.5%. The catalyst is exactly what I'm describing: enterprises realizing that when AI agents can do the work, they don't need per seat licenses for humans to do it, and that they can use AI to build the software themselves in house. Salesforce is down about a third. Snowflake fell 37% on fears that AI models will just query data lakes directly. Intuit dropped 46%. UiPath collapsed because its automation product now competes with any coding agent that can write the automation directly. Vibe coding, as it's called, software written by a person working with AI in an afternoon, is showing up in sell side research as a real threat to 7 figure enterprise contracts. If that trend continues, we end up in a genuinely counterintuitive market. Non tech sectors absorb the productivity dividend and expand margins, while the software application layer of tech giants gets eaten. Tech craters while everything else surges. The strongest pushback against my position is this: mission critical software is sticky. ServiceNow's configuration database is wired into security, audit logs, business logic. You don't rip that out because a chatbot can write Python, right? Enterprises don't trust AI agents to run unsupervised against financial systems. The companies with deep data moats and workflow integration, Microsoft, Google, the systems of record, might get more entrenched, not less. And every previous so called death of software prediction has been wrong. Open source didn't kill enterprise software, cloud didn't kill on premise. I'd grant that for the platform companies like Microsoft, Google, the workflow incumbents with security built into the product, I'd grant that that's true for them. Niche stuff like Jack Henry and Associates is also going to probably do more than well. They probably all come out fine, right? which is actually consistent with my first point. But the layer in between, per seat application software that doesn't own the data or the workflow, that's what's in real trouble. And the market is already pricing it in. In March, Douchebank told clients they couldn't find a single software company expecting negative AI impact in 2026. 2 weeks later, the sector sold off hard anyway. So, when management is the last to know, that's exactly when I think you should be skeptical of the consensus. And here's my third and final reason for not being all in on the AI trade, and the one that's gotten the least attention, in my view. The most profitable AI application so far has been code. That's not speculation, it's Anthropic's revenue mix. And it's the deal that valued Cursor's acquisition rights at $60 billion. dollars. The coding workflow is where the actual money is for this industry. The problem is that code is the application most vulnerable to commoditization. Programming language syntax barely changes, right? Python today is essentially Python from 2010. The semantics are stable, the libraries are documented, the training data is abundant, and you don't need a frontier model to write good code. You just need a competent one that does the job fine. And that's where local models come in. Tools like Ollama and LM Studio let any developer run capable coding models for free on their own machine with zero API bills and nothing leaving their network. And I know it works because I've done it. I've put Ollama on my MacBook Air and it ran just fine for models that I needed to tinker around with. I mean, open weight models like Quinn 3 Coder and DeepSeek Coder are closing the gap with frontier models on standard benchmarks. Sure, they're not as good on the hardest problems. They don't need to be, because most real world coding is UI components, bug fixes, refactors, and boilerplate. And a model running on a laptop handles that fine. Also, if you have a coding background like I do, you just need a model that's okay to get you started. And then you can go the rest of the way. And that's way cheaper than, hiring a person that has no idea what they're doing and throwing them at a frontier model and just setting your money on fire. So now compare the cost. Premium AI coding subscriptions run $20 to $40 per user per month. And that's being generous because they've been going way up recently. And they scale up fast with usage if you're burning tokens. So multiply that across a 200-person engineering org, and you're looking at a six-figure annual line item. The local alternative costs zero beyond the laptop you already own. Tools like Klein, Continue.dev, and OpenCode are explicitly built to let developers switch between cloud and local models on demand. The architecture is designed to commoditize the model layer. If the most profitable AI application is code, and code is the application most exposed to local model substitution, then the revenue base propping up the pure play valuations is sitting on a commodity. That gets worse if the technology plateaus, which it probably will. Nothing grows exponentially forever. If frontier progress slows, open weight models catch up and the premium evaporates. The companies most exposed are every AI player that isn't named Microsoft or Google, because those two have the bundled distribution to keep monetizing even a commoditized model layer. That's the world I honestly think we're heading toward. A more decentralized tech stack where some pure plays survive, but the trade as currently priced doesn't work. The counter argument here, I will admit, is strong. Most enterprises don't actually want to run their own models. The total cost of the GPUs, ops staff, evals, and security review at scale can exceed an API bill for a mid sized company. Cursor isn't selling raw inference, it's selling a polished, integrated product with sandboxes and agent tooling that local stacks haven't fully matched. And frontier models are still meaningfully better on the hardest problems, which is exactly where companies are willing to pay up. That holds for the cutting edge. But three things are happening at once here. Local models keep closing the gap, the open source tooling around them keeps maturing, and enterprise procurement cycles are starting to ask why they're paying per seat for something their own machine learning teams could run on infrastructure they already have. Once one major company publishes a case study about migrating, the rest tend to follow within a couple of years. These big companies, they're herd animals, right? They herd together. This won't happen next quarter, but on a 5 year horizon, the coding revenue stream propping up the entire pure play case is the most commoditizable revenue in software, in my opinion. And that's the opposite of what you want to see at 78 times sales. Put it together. The pure plays are competing in a market where compute, distribution, and capital all favor the incumbents. And the incumbents already own equity in the pure plays. If AI, as advertised, works, the productivity dividend flows to the users of AI, not the sellers. And the application software layer of tech gets eaten in the process. And the most lucrative AI application, code, is the one most exposed to commoditization, with that exposure getting worse if progress slows, which I think it inevitably will. So I'm not short AI and I'm not bearish on the technology itself, but I'm not paying 78 times sales for a pure play. I'm not concentrated in per seat software names, and I'm not going to play ball in a game where it's a loser's game. I'm taking Goldman's hint seriously. The non tech companies quietly using AI to expand margins might be the cleanest way to play this. We may be heading toward a more decentralized tech stack, where the value of AI gets absorbed across the whole economy instead of concentrated at the top of the index. And if that happens, the consensus trade ends up on the wrong side of that transfer. That's a contrarian view, I'll admit, and it might be wrong. But the consensus trade is crowded enough right now that being contrarian feels like the only place the risk reward calculus still works. Anyway, thanks for watching Miller Momentum. If you enjoyed today's video, don't forget to like and subscribe and drop me a comment on your thoughts about AI. Until next time.